Hi guys, welcome to a new episode of Bad Number Crunching. In this one, we will examine Dave Ramsey's video, Drive Free, Retire Rich. I agree with him in principle that buying a new car on interest is bad and saving your money is good, but I think he's kind of off with the math. If you've not seen his video yet, I recommend you go check it out first, because it's only fair that you see what he says and then see what I have to say to it. And in all probability, you might actually catch his mistakes yourself. So look in my description box, so go watch that and then come back. Thanks. Okay, so Dave says that your average car payment is $475 a month. I won't really challenge that. For the sake of this calculation, that's fine. We will use that number and work with it for now. He says that if you live car payment to car payment for 40 years, that is, you make a car payment at $475 a month, and as soon as it's done, you get a new car and keep doing it for 40 years. Not only is that not realistic, fine, we'll go with that. Let's, for the sake of argument, say that somebody's so stupid he makes a $475 car payment for the rest of his life for 40 years. What is that going to cost him? Nominally, without any interest, it'll cost him about $230,000. Now, yeah, that is a lot of money, but nothing compared to what Dave is telling you. Dave Ramsey says that if you didn't have this car payment, or if you invested $475 a month for 40 years, you would earn or have, at the end, $5.5 million. In other words, he's trying to tell you that by buying a new car, this stupid decision will ultimately cost you $5.5 million. I call bullshit. Why? Because in order to earn $5.5 million at the end of 40 years, you have to, without fail, earn 12% every darn year. When was the last time somebody steadily earned anything, consistently, for even 10 years? If you look outside your window, you'll see that if you go to a bank today and said, I'll lend you my money, all I ask is 2% for 10 years. Can you do that? They'll likely say, no, sir, we cannot. Even though 2% is pretty low, we cannot even promise for 10 years to deliver that every year. The only two things in the American financial system that are legally allowed to guarantee a fixed rate of return that I can think of, I could be wrong, there may be a few others, is a mortgage and a treasury bond. These are the things that actually have a commitment of 30 years. Nothing else and nobody else is willing to promise a fixed rate of return every year without fail for more than even 5 years. That's why banks right now would only sign CDs for 5 years. Not many people are willing to guarantee a 10-year return. Therefore, a person who lived car payment to car payment for 40 years would, on the surface, waste $230,000 if he didn't invest it at any interest. But don't think that that is therefore, if he earned interest, he's going to realistically make $5.5 million. So let's look at some more realistic examples. Again, if you were to actually save or invest $475 every month for 480 months, that is 12 months a year for 40 years, you would have about $230,000 baseline. If you don't lose any of it, even without interest, $230,000 is about what you have. At 2%, and this is a much more realistic number, if you constantly put it in a CD, and the bank always gave you 2% every year for 40 years, then you would have $350,000. At 5%, this is not what a bank would always give you, but let's say you sometimes invested in something earning a little more and sometimes put it in the bank. Between that, back and forth, 5%. It's much higher than the banks are offering, but much lower than Dave Ramsey's estimation. At 5%, 40 years, you would have $730,000 if you invested $475 per month, about $500 a month. At 8%, this is where we'll break $1 million. If you were to earn 8% every year without fail for 40 years, solid, you would make $1.5 million or 1.6, somewhere in that ballpark. I'm willing to stop right there. That I'm willing to say right now, and I think an honest person should as well, that over the course of 40 years, you should really not expect any investment to return more than a steady 8% every year. And this, we're talking about hands off. If you were just to hand it to a fund manager or put it in a house, 8% is pretty high for somebody who doesn't know what he's doing and doesn't have to actually actively do the trading and watching. So realistically, between 0% and 8%, over the course of 40 years, a person who lives by paying car payments for 40 years would lose realistically between $250,000 to $1.5 million. It is only and only when you assume outrageously and completely unrealistically that your mutual fund or investments or retirement fund, whatever you want to call it, makes 12% every darn year for 40 years. That is when you will end up with the outrageous and laughable number of $5 million. So don't fool yourself. I agree with Dave Ramsey in principle. You should save money, and you shouldn't buy a new car if you don't have the money. You shouldn't get a car loan. You should live within your means. You should buy a used car if you can handle it, and live on used cars as much as you can, because saving a couple $100s a month is a good habit. But don't fool yourself into thinking that just because you save $500 a month, that in 40 years you'll have $5 million. Because if we learned anything the past 2 or 3 years, it's that many people lost a big chunk of their retirement savings. If what Dave Ramsey says was remotely true, Wall Street probably wouldn't need a bailout. And people who expect to retire in 2008, 2009 would have. And Americans would probably not be in a housing bubble. These are the things that were not expected by most people. They were by some. But most people don't look, calculate, and expect these losses. And this is what Dave Ramsey is not considering. So think about this a little. Try saving your money and don't buy what you can't afford. Avoid debt. These are good habits. But don't lie to yourself. If you really need to be threatened by $5 million, you're probably not going to be very good at financing or saving. But if you just tell yourself that saving is earning and not owing money is saving, I think you'll do just fine.